Hello, everyone. Welcome to Financial Literacy for Business Owners. It is so very good to see you. And yes, if you have been with me before, I'm seeing some familiar names. So for those of you, Beth, I'm noticing a familiar name. Carlos, hello. I know I owe you an email back, Carlos. So I haven't forgotten about you. Just working on getting caught up on my email since I was gone last week. So it was good to see some of you. Yes, I'm in a different room. My podcast room. I was working in here and I was like, you know what? I just don't feel like moving my laptop. So I'm in my conference room, which is surrounded by books and a very, very messy, large table. Which is littered with books right now. And I'm a little bit too embarrassed to just show you what it would look like, maybe some other time. But if you follow me on social media, you see how messy my big, long conference table gets because I have different books out, different research that I'm doing at any given time. But that is not why you're here. You are being gracious and letting me bloviate for just a second. But this is why we're here, is financial literacy for business owners. And some of you, I think this might be a couple, you've been through this a couple different times. There's a lot of information here and there's a lot to go through. So we're going to get right to it. If for those of you who have not already put your location and what business that you're in, please go ahead and put that in the comment section. I see Carlos again. You've got an independent record label, which is super exciting. I think that's really, really cool. Beth, you're joining us from, is it Westbrook? Is it Maine? Very good. And let's see. Michelle again is helping us on the back end. So thank you, Michelle, for helping out. Natasha, hello. Good to see you. Hello, Carrie. And all right, and Kendra, hello. All right, well, let's again, if you can go ahead and just plug in what business that you're in and also where you're from. One quick thing, Syracuse, New York. I grew up in the Catskills, so I know right where you're at, Kendra. Has it snowed up there yet? Probably close to it. All right, so a couple real quick things. I'm gonna answer this question in advance. Is there going to be a replay? Yes. And we will send it to you in your email. The email that you can expect it to come from is markdolfini.com. So it'll be coming from events@markdolfini.com. And we promise not to blow you up with a bunch of spam. You're not going to be stuck on some list that you're going to be like, oh my gosh, how do I get rid of these people? But if you don't want to get emails from me, then just tell me. I won't email you, but I like to email. I like to keep people in connection. You're from London. Very good. Nick, glad that you can join us. And from New York, live in North Carolina, own a salon, looking to expand. Very good. I bet you're glad you're not living in the drama going on in New York right now. That is, no matter what affiliation you are in, that is, there's a lot going on in New York. So glad that you can join us, Natasha. Let's see. Very good. And you're from, oh, wow, France, e-commerce. Very good. Well, sorry, it's hard to read the names. Thalia, is that maybe Talia? That sounds like probably right. All right. Well, so one quick thing. Yes, you are going to be getting a replay. We will be sending that to you in your email. One other quick thing I just want to point out for those of you who have questions at the end, I'm going to do my best to stick around and answer some questions. But I have been getting a lot of people asking questions outside of these. And one of the things I thought I would do is host a Q&A session, just a Q&A session. I've been hosting a lot of these types of events. There's no teaching. I might have like a 5-minute thing in the very beginning, but it's entirely Q&A. If you want to go to this, we'll put the link up. If you want to go to EventBrite, you can find it there, but we'll put the direct link up for Saturday. Sorry, my mic is real hot. So if you want to join that for Saturday, it's a full hour of just Q&A. Ask me anything related to business. You can even ask me personal questions if you really want. I'm an open book. I really don't have any reason to not answer questions. So, but it's really questions related to you as the avatar who are, business owners. Maybe you've got kids at home. Maybe you've got a family, a wife, a husband, and you're just trying to navigate it all and trying to make it all work. So Michelle has got that typed up this Saturday, November 8th at 8 a.m. Eastern time. So I know I've got people all over the world trying to navigate this. Unfortunately, that's the only time I can really make work on my Saturday schedule. So she's got the link up there if you want to try to copy and paste that. Otherwise, you can go to EventBrite and get logged in on that. All right, so you guys are here for financial literacy for business owners. And I just want to let you know that I want you to encourage you to stay plugged in for the next 55 minutes. I'm going to try to put the fries in the bag right at the top of the hour so you guys can get back to your day. And the main thing that I want to, like, obviously we've got some people joining us from France, from the UK. It's later for you, and I know you might be trying to put kids to bed or just doing other things, but please do the best you can not to multitask. For those of you who are in the United States, I know you're still in the middle of your workday, but do the very best you can not to multitask, because right now I want to there's a lot that I'm going to hit you for the next 55 minutes. And if it's worth doing, it's worth being completely plugged into, paying attention to. And what we're trying to do is train our brains, right? Training our brains to be more attentive, to be more focused. And I'm just letting you know, like right now, just trying to multitask is not going to serve you as well as you think it is. So just please stay plugged in for the next 50 minutes or so, and then I'll give you plenty of value, I promise. All right, so here's the agenda for today. First and foremost, we're going to be going through the Viper method. The Viper methodology is what I wrote in the Time Wealthy Advantage. I'll talk about that here in a little bit. That's my last book, but we're also going to talk about the 4 core functions of business, the 4 core functions that every business has to have. We'll also be talking about specifically financial statements, and we'll talk about balance sheet, we'll talk about income statement and P&L. We're going to be talking about those very basic financial statements. There's lots of other financial statements, but those are the 2 basics that we're going to be hitting. We're going to be talking about a phenomenon called growing broke. And this is what happens specifically with companies that are growing. So for those of you, just Talia. Okay, sorry, I was pronouncing that incorrect. All right, I'm glad you could join. Thank you for correcting me, Talia. My last name is Dolfini. Most people get it wrong. It drives me crazy. So it's not that hard. So I always try to make a point of pronouncing people's name correctly. But where's all my cash? So this is a phenomenon of profit versus cash flow. And a lot of times companies can be growing, and they start growing faster than their ability to generate cash. And there's lots of reasons this happens. Sometimes they borrow too much. Sometimes their sales are actually growing faster than their ability to generate cash because their collection cycle isn't fast enough, isn't efficient enough. There's lots of different reasons. Even pricing, you can price yourself out of and not price yourself high enough to grow your cash. So this is really important to pay attention to this phenomenon called growing broke. And then finally, I'm going to give you some resources at the end. Some are free, some are paid. At the very end, I'm just going to let you know now. I will let you know in advance if you want to hop off and say, hey, I'm not interested in anything free. I don't like your face, whatever. You can leave at any time, obviously. But there is a paid offer at the very end. I don't do this on every session, but there is one it's got a lot of value because it's specific to finance related to business owners. So if you're interested, it's not a lot of money. It's not like hundreds of dollars or anything crazy. I just want to make sure that I let you know this in advance, so you're not like, aha, the other shoe is dropping. I'm just letting you know in advance. I'll tell you, hey, this is the end of the presentation. If you want to hop off, if you're not interested in buying anything, I'll just let you know that in advance, so that way you're not going to miss anything. All right. So if that sounds fair enough, that's what I'm going to do. All right. So here's everything I'm going to be talking about. These are the 8 different books that I have written over the years. That book on the top left, if you look at that, that's called The Time Wealthy Advantage. I'm going to get myself down to the bottom here. And that's The Time Wealthy Advantage. That's my very first book. That was a real estate related book. And these are the other books that I have written. And these are specific to the avatar of a small business owner. This is my last book, The Time Wealthy Advantage, which is the biggest, longest book that I've written. It's just shy of 300 pages. And this really is the foundation of the Viper methodology. So if you live out of the United States and you'd like to order that book, you can get it on Amazon. Probably the best way for you to get it, because I can't really handle fulfillment outside the US. If you're inside the US, you can go to strategicboardroom.com and get a signed copy of it. And there's some other bonuses in there. But again, I'm not here to push that. I just want to let you know if you do want to get it, but do that later. Don't multitask. Okay. All right. Let's talk about the Viper method. This is the framework about how every business works. So what I'm going to do, I promise you we're going to get to finances, and we're going to get to finance. We're going to be talking mostly about finances. Give me about 10 minutes just to kind of walk through the framework that every business has to be structured. And then it's going to give context in terms of why finances are so important. Because many times people are like, oh, I'm just not a numbers person. Listen, who are my people out there that identify, plug in, 100% focus. Thank you, Carrie. Right? Very, very good. I appreciate that. But the reality is many people out there like to identify, love to self-identify as, oh, I'm just not a numbers person. I'm not a numbers person, right? I'm not going to ask anybody here to indict themselves, but I hear that all the time. And here's the reality. Accounting is not about numbers as much as it is about rules. And if you can play games like Monopoly, if you can play games like Candyland, if you can play games like Solitaire, you understand rules. And that's all that bookkeeping and accounting is just understanding rules. Yes, of course, it talks in the language of numbers. But guess what? So does Candyland. You spin the spinner and you go 7 places. 1, 2, 3, 4, 5, 6, 7. That's numbers. Don't tell me that you don't understand numbers, right? So if you understand how to add, subtract, multiply, and divide, and if you can operate a 4-function calculator, you can understand everything I'm going to talk to you about today. And realistically, it's not even that much division. It's mostly addition and subtraction. Okay, so set that aside. I'll hold your hand metaphorically. It won't be weird. Okay, we can learn this. We can learn this together. All right. So let's go through the framework, the Viper framework first and foremost. To start out. So the Viper framework, the methodology is Viper is an acronym for Vision, Infrastructure, Process, Execution, and Reporting. And what this is a strategic approach to looking and constructing a framework for your business. So let's walk through what each of these things are. The vision piece is it's broken down into 2 main areas, right? You have a personal vision and you have a business vision. So when you're looking at your personal vision and your business vision, they fundamentally ask 2 basic questions. One related to your personal vision, which is, where do you want to go? Where do you, Talia, want to go? Carrie, where do you want to go? Beth, where do you want to go? Right? Like those are, and I'm talking about in life. I'm not talking about necessarily in business. I'm talking about if you woke up with $30 million or 30 million pounds or, or 30 million euro in your bank account tomorrow, what would your day-to-day life look like if you did not have to rely on income generation, right? So that's why I'm saying, like, the personal vision is simply, where do you want to go? What would your day-to-day life look like if you weren't worried about income generation? Excuse me. Sorry, I'm just getting over a cold and my throat is just not holding up like it used to. All right, so where do you want to go? The business vision is going to ask a question. Great, that's where you want to go. How are we going to get there? So the business vision exists to serve the personal vision. And many times when I talk to a small business owner, small business operator, solopreneur, or even a business owner in general that may have 20, 30, 40 employees, that if I'm asking them and I say, hey, what's your vision? They're going to answer it in a business context. Most often they're going to say, well, I really want another 100 customers. I really want another $10 million in sales. I really want to sell another 50,000 widgets, whatever it is. When in fact, the reality is they never take the time to construct a personal vision. And that personal vision is just basically where they want to go. So in fact, the business vision becomes a personal vision. They end up creating a life that exists to serve the business. And that's the danger. The danger in creating a business vision before you ever create a personal vision is that you end up creating a life that exists to serve the business. Okay. So that's why I'm saying, like, I'm not suggesting that business vision is irrelevant. We're going to come to that here in a second, but it just can't come first. So let's look at personal vision. So I'm just going to take another couple minutes on this, and then we're going to be done with personal vision. But I just want to make this point, is that personal vision, a way to construct it, a really easy way to construct this, is to think of your 100th birthday speech. There you are, you're turning 100 years old. Think about who you would want to be in the room. Who would you want to be there, right? And what would you say during your 100th birthday speech? What would you say to the people in the room? And, those are the 2 main questions. You could say, well, who are the people in the room? What would you say? What would you want people to say outside of the room after you were done speaking? Like, what would be your legacy? Start thinking about that in the context of your 100th birthday speech. Okay. So when you start thinking about your 3 C's of business vision, I want you to think of 3 C's, okay? The business vision, I want you to think of 3 C's, is core purpose, core values, and client avatar. Core purpose, core values, and client avatar. When you're thinking about your core purpose, I want you to think specifically what business that you're in and what problems do you solve. What business are you in? What problems do you solve? And I want you to be highly specific in those answers. If you just say that you're in real estate, that's fine. That's not very specific though. But if you say that you sell real estate on the south side of Manchester, that's a little bit more specific. But if you say I'm specifically in single family residential houses in the south side of Manchester in this school district, okay, now you've got my attention. Now I know that you kind of know that geography real well. What business that you're in and what problems do you solve? So this is where I'm starting to suggest to you is get really dialed in terms of what business that you will do, like what the business is and what the business isn't. Because if you start fragmenting yourself too much, if I said, well, yeah, I kind of do marketing for people and I kind of do sales training for people and I mean, can I do those things? Yes. But am I a sales trainer? No. I have done sales training. In fact, I've done a fair amount of sales training. But if I'm looking at, dialing in specifically to a specific niche within sales training, I don't know. I'd have to do some research before I could say that I know that industry well. So I don't advertise myself as that. I'm a strategist. That's what I do. I work within 4 core functions: lead gen, sales, operations, accounting. And I look at the efficiencies within those 4 core functions. And you'll hear me talk about that here in a second. But that's why it's really important for you to really know your core purpose of what business that you're specifically in and what problems you specifically solve. Let's look at core values. The core values are just what matters to you in this business. And how would the world be worse off if you were no longer in business? Think about it from the context of, the values, the company culture. When you're thinking about company culture, the culture is what helps define and determine the company brand. So if you know a company, you're like, man, I really like the way that company does business. Now you can start to think like, well, where did that come from? That comes from company culture. That comes from a well-defined set of core values. So the reason I'm bringing this up now is because if you, as the owner and operator of this business, if you're trying to grow this organization and you're trying to grow it by bringing other people into the organization, which you will need to do, you can't do it all. You just can't. You're just not as efficient as you can be. You need other people to do other things for you. The math doesn't work if you really are wanting to make it at a big level. So if you're trying to understand, again, even from the financial perspective, you really need to start thinking about your core values. So when you're bringing people into the organization, the core values are already determined. So that way you're not bringing in someone that's not in alignment with your core values. Have you ever worked with someone whose values don't align with yours? It's awful, right? Like it's just, so this is why I'm saying you want to make sure that these core values are defined for your business. Next is the 3rd C of business vision, which is your client avatars. Who specifically and ideally do you want to serve? And I want you to think about their geographics, their demographics, and their psychographics. Their geographics are where they are. The demographics is who they are. And the psychographics is how they think and how they buy. So for those of you, again, all of you bought into today's session with your time. You didn't pay anything for this, right? But the thing is, you bought into it with your time. So I knew how you think. I had to change the title to this a couple different times because the first couple times I put it out there, I don't remember the exact names that I put out there, but no one wanted it. The minute I called it financial literacy for business owners, people were really wanting to be here, right? Because I understood how they thought. It took me a while to figure that out. And sometimes it takes some testing. So and I may continue to test it. I might change the name a little bit more, right? To see how many people, but a lot of people, this is one of my more popular seminars because people really, they struggle with financial literacy. And I'm telling you, it's not as complex as you think, but I'm telling you this now so that when you start to try to grow your business and scale your business, and now you got all this money coming in, that you understand why they're coming to you in the first place, because you understand the demographics, the geographics, and the psychographics. So when you're thinking about psychographics, think of the term ALIA, A-L-I-A. You want to think of their attitudes, their lifestyles, their interests, and their aspirations, their goals. So think about it from that perspective. And when you understand that, it's much easier to attract them in your marketing. I talk about more of this in my seminar called Marketing Magic. I also talk about this quite a bit in Strategic Business Growth Multiplier. So either of those courses, if you're interested, you can find those coming up on EventBrite. So that is the 3 C's of the business vision. We talked core purpose, we talked core values, and we talked client avatar. And that's going to put the fries in the bag for vision, right? We talk personal vision and for business vision. So let's talk quickly about infrastructure. Infrastructure is the bones of the business. It's your desks, the chairs, the software, the phone systems, right? The payment processing stuff. This is all stuff that websites, these are all different things that you need for the infrastructure, for the basic bones of a business. And every business needs this stuff. And the reason that infrastructure comes next is because, you've been thinking about this personal vision, right? And remember, the business vision exists to serve the personal vision. So if your personal vision is to lay on the beach in Spain, rubbing cocoa butter on your belly for 2 months out of the year, that's a fine vision. Might not be a great visual, but a good vision. Well, if you set up an infrastructure that requires you to return emails and phone calls in a timely manner, that's going to be a horrible experience for you when you're trying to lay on the beach rubbing cocoa butter on your belly, right? So this is why you're going to create an infrastructure that's in alignment with both business vision and personal vision. So that's the infrastructure piece. So when we talked vision, we talked infrastructure. Now let's talk about process. Process is simply how you do stuff. You want to think about that in the context of both tactical process and strategic process. The tactical process is simply your day-to-day, boring standard operating procedures, your checklist stuff, just your day-to-day activities, how your opening procedures, your closing procedures, how you answer the phone, how you do bank deposits, all these sorts of things like that are just boring stuff that no one ever wants to take the time to document. And that's what I would recommend for you to take the time to document it, right? Because this is where your consistency comes in. When you're looking at the other side of process, this is where strategic planning comes into place, right? So when you've got your infrastructure, you've got your tactical processes, they're all built out. Now you want to take this business and go somewhere with it, right? You built this warship, you built this battleship, and you want to take it out of the harbor. That's what strategic planning does. And you do that by delineating what people you're going to need, what's the strategic purpose you're trying to accomplish, and what is the promotional piece. So the people are just simply, do you need to hire salespeople? Do you need to hire more people to handle fulfillment? Do you need some marketing folks, right? Do you need to hire a bookkeeper, right? Those are a great example of different people that you may need. When you're looking at the purpose, you might be thinking, well, what's the strategic purpose? Am I trying to enter a new market? Am I trying to expand vertically into a market, right? Am I offering a new product, new service, things like that? That's the purpose that you need to make sure. And that purpose also needs to be in line with, that's right, your core purpose. It needs to be in alignment. Your strategic purpose needs to be in alignment with your core purpose. Because if it doesn't, that would make no sense. That would be like Starbucks coffee selling chainsaws. It doesn't align and it gets really confusing. This is also why the promotional piece is also really important. Promotion is not just telling the external world what you're doing. Promotion is also communicating to the people internally what you're doing, right? Have you ever called a place and you're like, hey, I'm calling about your thing. And the person on the other end of the phone's like, are we selling those, right? That's why you need to consider promotion when you're looking at your strategic planning. So that's the process piece. Execution is next. This is one of my favorite quotes from General George Patton. A good plan violently executed now is better than the perfect plan executed next week. And that's a great quote by George Patton. And the reason why I delineate execution is that most plans fall apart in execution. And that's because many people have way too many priorities on their to-do list. Where are my people at where you've got 37 items on your to-do list? You know who you are, okay? So that's why that's why I want you to start thinking about this in the context of having not a limited number of priorities. That's why I like to break those down into daily 5. So the daily 5 comes into, these are your 5 highly specific actions that you're going to do every single day. And they may not be the same 5 every day, but these are the 5 highly specific actions that you're going to do every day that are going to move the needle towards your vision or your strategic plan, one of the two, okay? And then the last piece is reporting. Reporting is lead metrics and lag metrics. Lead metrics are simply based on your actions and activities. and the lag metrics are the results of those actions and activities. So later on, I know this is a financial literacy piece, and we're gonna start getting closer to that here in just a hot second. But the results of the actions and activities, those are your financial metrics, and we're gonna be talking about financial metrics here at the end. So this is why I'm saying the reporting function is really, really important to measure the effectiveness of your actions and activities. That's all financial literacy does. That's what it does, is it puts numbers in the context of what it was that you were doing for the previous month, previous quarter, previous year. Okay, so this whole framework here, the strategic framework, is really, really important if you're trying to build a business that actually is worth something. Okay, so thank you for those of you who stuck around. I just want to make sure that you guys understood what this was. So let's get into the 4 core functions of business. The 4 core functions are lead generation, sales, operations, and accounting. And the lead generation, you have to understand that everything needs to support your lead generation function. That's why we're here, again, for the financial literacy piece. If you're trying to grow your operation, you have to recognize that financial literacy is really important to fund the lead generation, because you can have the best, most efficient business. You can be a paragon of virtue. Your sales technique is so dialed in, you could sell voting booths to Castro and you can still starve, right? So you can never take your foot off the gas when it comes to lead generation. That's just the reality of it. So the sales process continues the conversation which is started in the lead generation function. And it also understands that effective selling is about finding solutions. It's not about, it's not about holding people's heads underwater until they say yes. When the operational function, so we talk lead gen, we talk sales, now we're going to talk about operation. The operational function is, if you're going to get stuck, you're going to get stuck in the operational function. That's generally what happens, okay? And if you're a roofer, you end up doing roofs. If you're a baker, you end up doing baking, right? Those are the sorts of things. If you're going to get stuck, if you're going to ignore something, generally you're going to ignore the accounting function. And generally it happens like this. Well, I've got more money in my bank account this month than last month. I must be doing okay, right? I have said those very same things, and I'm telling you, and I have an accounting degree, okay? I'm just letting you know it doesn't work out the way that you think. It's not going to be as effective as you think. Hold on one second. Okay. Can you guys hear me better now? Okay. So it's not going to be as it doesn't magically fix itself if you don't spend the time, really truly getting dialed in on your accounting function. There's a slight buzzing. Okay. Hang on 1 second. Let me dial that in. So I was getting some feedback. That's why I changed the mic. Is that better? No. Okay. Let me change. Sorry, guys. I was getting some feedback. It's worse. Okay. How is that? Is that any better? I'm getting a thumbs up. Okay, thank you. Sorry, I was getting some feedback in my headphones. All right. So this is the things that I just need you to pay attention to. All right, thank you, Carrie. All right, so in the accounting function, great, thank you, Natasha. All right, so the accounting function is what collects the money, right? It pays the bills, and in the accounting function, it tracks and measures everything that happened, and it also serves a really important function for forecasts and budgets and plans for what will happen, right? So there's a really important function here that the accounting function serves. Now, stop and ask yourself for just a second, are all of these things the same skill set? No, they're not the same skill set. In fact, they're very different, right? I would make an argument that lead generation does have some similarity to sales, but they're not the same thing by any stretch, okay? And I could even make the argument that lead generation and accounting are actually pretty similar because they're very metrics based if you're doing them correctly. So that's the 4 core functions of business. And I want to make sure that you understand that, as we head into the financial statements and understanding the financial statements now, this is really, really important, for the financial piece. Or understanding the financial piece. And this is directly related to the financial statements. Okay. So let's look at the balance sheet and let's look at the the balance sheet and the income statement and P&L. Has anybody ever heard income statement and P&L or profit and loss? I'm telling you, all 3 of those things are exactly the same thing. Income statement, P&L, profit and loss, they're all the same thing. So thank you, Natasha. If you have heard those, And you're like, well, what's the difference between an income statement and a P&L? It's vernacular. It's just someone using a different phrase for the same exact thing. So I'm just letting you know from an income statement, from an accounting purist perspective, it's called an income statement. So I have a degree in accounting. That's what I've always known it as. When people started referring to it as a P&L, I was like, well, what is a P&L? And then I was like, oh, it's an income statement. So I just want to let you know it's the same thing. All right. So I'm going to give you a quick rundown of what a balance sheet is. A balance sheet it's broken down into three components: assets, liabilities, and equity. Assets are what you own. That's what you own. So if you own a car, if you own a house, if you own, if you own a vehicle in the name of your business or whatever, that's what you own. Okay. Liabilities are what you owe to others. That's what you owe. Let's say that you have a mortgage, you have a car loan, and whatever it is. And there's the balances at any one specific point in time. So in other words, when you're looking at that, it's really important that you stop and think about that in terms of what is owned, what is owed. And if you take what is owned, right, and what is owed, and you subtract those two, what's left on paper is your equity. Okay. So in other words, let's say that you buy a building, and it's a $200,000 building, and you buy it for, let's say, 75,000, or let's say that you get a mortgage on it for 75,000, right? So now 200,000 minus 75,000 that leaves you $125,000 in equity. Now on a balance sheet, generally that never adjusts, right? That value stays the same. Okay, so I just want to let you know that that's how that works. So that's why I'm saying, from a balance sheet perspective, it's always at a very specific point in time, and that is so in other words, it could be for the end of the month, end of the year, things like that, right? So if you check your balance sheet in the morning and you check your balance sheet in the evening, it could be different because cash balances could change, for example. Okay, so we'll get into that here in a second. The income statement is also broken down into three areas. The income statement is broken down into revenues, it's broken down into expenses, and your net income. So while the balance sheet is at a specific moment in time, the income statement is it reveals data over a period of time. So in other words, if you're looking at the fourth quarter, right, which would be, you got October, November, December, right? So you got the fourth quarter, that'd be 3 months. That would be your income statement. So it's going to capture all the revenues or the sales for that 3-month period, or it could be for a month period, right? It's not often you see an income statement for one day, although it's possible, right? How much money did you make today, for example, right? Your expenses are the payments that you sent out. So that would be the bills that you paid. So in other words, if you have a mortgage, and just to keep the math easy, let's say that you paid $500 out on the mortgage, you would have expenses of $500. Yes, I know for those of you who are accounting purists, like, no, that's not true because part of it's principal, part of it's interest. Just stay with me for right now. Let's just say it's all interest. So you sent $500 out, that would be $500 worth of expenses in that period. So I just want to let you know that the income statement, the P&L, profit and loss, when you take the revenues, you subtract out the expenses, what's left over is the net income, right? Or net loss, they're generally called your profit. So in other words, if you have more revenues than expenses, you are left with a profit. If you have higher expenses than sales, you will have a net loss. All right, so that is the balance sheet and the income statement. Everything that I'm talking about here this is excerpted from the Time Wealthy Advantage. I'm going to take myself off the screen here just so it's a little bit easier for you to see this. I'm going to go into the kind of the nuts and bolts of this, like I promised, in terms of understanding the balance sheet. So this balance sheet here, if you want to take a screenshot, or again, this will be sent to you on replay. This is a very, very, very basic balance sheet where you have the assets at the top, the liabilities in the middle there, and then the equity at the bottom, right? So if you're looking at your assets, you subtract out the liabilities, you will have the equity at the bottom. So let's take a look at the assets first. Again, this is what you this is what you own in your company. So from this perspective, you've got, it's not advancing, there we go. So you've got your assets at the top. So your assets, what you're going to notice here is you've got your cash balance start at the top, you've got your accounts receivable, you've got your vehicles, you've got your real estate, okay? And then you're going to add up the total assets. So in this particular case, you've got cash in the bank, right? And this is, again, for a specific period of time. So let's just say at the end of last month. So at the end of last month, and that's been reconciled. So you look at the cash balance in your checking account. Let's say that you've got, a checking account with, Wells Fargo, for example, and you got $10,350 or pounds or whatever. And by the way, I know I've got multiple people here from multiple different countries. Yes, this is translatable across the world. This is known as GAAP, GAAP, GAAP. And that stands for Generally Accepted Accounting Principles. So when I'm looking at this, what you're going to see here in terms of the assets is you're going to look at the most liquid assets up top and the least liquid assets at the bottom. So when I'm talking liquidity, I'm talking about the asset that can most convictly convert to cash. So if there's cash balance in a checking account, obviously that can convert to cash pretty readily. If you have accounts receivable, that's money that people owe you. That would take a little bit of collection activity in order to get, right? If you need to sell that vehicle, right, you'd have to go out and find a buyer, right? So it's just in terms of how liquid it goes down to the bottom. So that's the total assets. So that if you look at, again, at the top of the balance sheet there, that's where you'll see the assets at the top. Let's look at the middle section, which is the liabilities. The liabilities, again, are listed from most liquid or most recent or short-term notes, basically from the top all the way to the bottom to long-term notes. So if you're looking at the top, you would expect to see like things like credit card balance that you might owe to, say, Chase or Barclays or something along those lines. You might have accounts payable to vendors that you have borrowed from that you have not paid. Let's say that for argument's sake that you're an HVAC company and you owe money to Train, right, which is a HVAC company. And they sell air handlers and outside condensing units, things like that. That's what you would owe to the accounts payable. And then you've got a van loan that you owe to Wells Fargo, and then of course you've got a real estate mortgage to Citibank. So again, all of those things added together is your total liabilities of $189,180. So if you take those two things and you subtract your total assets, right? So you got your total assets at the top of 417,000 minus 189 is total equity of 227, just shy of $228,000. Okay, so that is your total equity. Now let's move quickly to the income statement or P&L. So when you're looking at the income statement, again, it's revenues, expenses, and the bottom is the net income. So let's look at this. Now, again, I know this is basic, but it's important we get through the basics so you can understand the more complex stuff near at the end, because we're going to get into more financial literacy pieces here at the end. So let's look at the revenues. Revenues are, you might notice here, are broken out between product sales and service sales. So you've got a total amount of sales of $114,000. Remember, this is over a period of time. So this could be for 1 month, it could be for 1 quarter, it could be for 1 year, it could be for 9 months, it could be over any period of time. But let's just say, for argument's sake, this is a 1 month income statement. So from we'll say last month, which was October 1st to October 31st. So now we looked at revenues, and if you're looking at the percentages off to the right, I'm going to come back to those here in just a second. Then I'll explain what that is. So now let's look at your expenses. Your expenses are what you have paid out. So you've got your raw materials of $34,000. Again, that's just basic raw materials in terms of how to fabricate or whatever it is to do your, manufacturing of widgets or anything along those lines. You have insurance expense, interest expense. You may have commissions that you're paying out. You have wages, right? Those are the sorts of things. Your total expenses are $96,000. You have net income of $17,000. All right. So that is your basic income statement: revenues, expenses, and net income. All right. So why does this matter? What does this have to do with the price of tomatoes? Why should I even care? All right, let's get to why this matters at all. Because if you are planning on growing, you have to understand your growth planning strategy. And if you don't understand your numbers, this is going to be really hard to do because otherwise you're not going to know from one moment to the next how much money you're actually making. And can you fund future growth going forward? It makes it really, really tough. So let's talk about that. So you cannot be strategic if you don't know your numbers, and you cannot ensure that you're not going to grow broke. So let's look at these three key metrics. We're going to look at these three key metrics, which are profit margin percentage, cash balance history, and cash as a percentage of sales. So now we're going to take what we learned and we're going to just dial this up a little bit, okay? Don't worry about it. You're going to get the replay. If you get a little bit lost, you can always go back to the video. I just want you to know that this is not complex. This is just very, very basic math. And I'm going to show you what it means, okay? So let's take a look at the profit margin percentage first. And to do that, we're going to look at the income statement. So if you look at the income statement, let me get myself put down at the bottom here again. If you're going to look at the income statement, you might be questioning, what are those percentages on the right side of the income statement? Well, I'm glad you asked. So let's take a look. Remember I mentioned this before, where you've got the percentages there on the right-hand side. So when you're looking at that, the percentages on the right-hand side, the product sales and the service sales, if you add up those percentages, they equal 100%. So the total sales are $114,000 for the month. The product sales are 65%, almost 66% of the total sales. The service sales are 34% of the total sales. Why would that be important for you to know? Because you may realize that your service sales are being sold at a much higher margin, much higher profit margin. In other words, it's much more profitable for you to do service than it is to sell products. So you might say, well, shoot, if my service sales are only 34% of my total revenues, I'm not as profitable as I could be. So this is why it's important to break down the types of revenue streams that you have coming in for your different revenues. So again, if you have product sales, service sales, or you have multiple different products, it would be important for you to know how those things are broken out. So that's your total sales. When you're looking at it from an expense perspective, you do the same thing. And this is known as cost as a percentage of sales, or basically as a percentage of sales method. So when you're looking at your raw materials, you look at raw materials and say, oh, that's 34,000. Oh my gosh, that's a big number. Well, is it? It's 29.8% of your total sales. And why this matters is because when you start looking at stuff like this over time, and you're looking at this from one year to the next, your total sales might go up to $125,000. And your raw materials might go to $35,000. And you're like, oh my gosh, my raw material expense went up. Yeah, it went up, but as a percentage of sales, it actually went down. So this is why it's really important to pay attention to the percentage of sales when you're looking at your expenses, so you can understand what it is that you're actually looking at. The insurance expense is the same thing, right? It's 4.5% of sales. Interest expense, 2.2. Commissions is 8.6. And of course, wages is 39.5. So you might be thinking, well, is that good, bad, indifferent? Well, if it's going up as a percentage of sales, then I would be concerned. But if it's just going up as a raw number, I wouldn't necessarily be concerned, especially if my sales is increasing. So if my sales is going up, but my wages are also going up, but they're going up at a declining rate, then I wouldn't be nearly as concerned. In other words, again, let's say for argument's sake that, my total sales went to $200,000 for the month, right? And my wages went up to $50,000. Well, as a percentage of sales, that's a pretty easy mathematical calculation. I don't know the math off the top of my head, but I'm just saying that would be definitely lower than 39.5% of sales. That's why that would be important to know. So I'm telling you all this because at the bottom number there, the net income, that is known as your net profit percentage. And that is also known as your profit margin or profit margin percentage. Now, why is this important to know? This right here, if you take nothing else away, okay, and it's kind of unfortunate that several people have dropped off already, but here's the interesting thing. This is for the rest of you who are sticking this out, this is what is so important because you have to be on this number like a flippin' Band-Aid. And this is why this is so important. Let's pretend for argument's sake, just to keep the math super easy. We have revenues of $10, we have expenses of $8, and you have a net profit of $2, okay? Which leaves a net profit margin percentage of 20%, okay? Now let's pretend that your expenses go up $1. Your expenses go up $1. So now your expenses are $9. So in order to offset that dollar increase, you raise your prices by $1. So you can maintain your net profit of $2. But look at what happens. So you raise your prices $1 because your expenses go up $1. You're making the same $2, but what happened to your profit margin? Your profit margin went down. Your profit margin went down to 18.2%, which means your business is now less efficient at keeping dollars. And this is one way that you can grow broke. Even though your revenues are increasing, you're not as profitable as you were. So actually, to maintain that net profit percentage, what you should have done is raise your pricing by $1.20. So that would have been, if your prices went up $1, you would raise your pricing by $1.20. It would have mean $11.20, and that would maintain your net profit percentage of 20%, which your net profit would be $2.20. Make sense? So this is why it's so important to do this, and this is also why when you're looking at companies that are in an inflationary environment, this is why companies make more money in an inflationary environment. This is why, because when people are like, oh yeah, the prices never come down. They might come down, but they never come down to where they were, never. And actually you don't really even want them to, because that means you're in a deflationary environment, and deflation is horrible for an economy. It may sound good on paper, like, oh yeah, things are going cheaper. The problem is there's nothing as destructive to an economy as deflation. So I'll leave that there. That's an economic thing for you to do on your own time. But deflation is not a great thing. And it actually is very, very damaging to an economy. So this is why you want to raise your prices, but you want to maintain your profit margin percentage more than anything else. So actually, in the example that I gave you, if you went your revenues to $11.20, you would actually have a net profit of $2.20, which would maintain your profit margin of 20%. So that is the context of growing broke. So this, what I want you to do is I want you to think about the other part of the key metrics. We talked about profit margin percentage. Now let's talk about cash balance history. And we're also going to talk about cash as a percentage of sales. So first and foremost, let's look at cash balance history. This is pretty straightforward. It's not complex to understand. It's just basically understanding your cash balance history going from January, February, March. Again, this is just tracking your cash. And the thing is about tracking cash and why this is so important is because most businesses don't have near enough cash. And if your cash balance is not growing, I'm telling you, you are not managing your risk. And I hear this a lot, especially now. Keep in mind, most of my money comes in from the real estate world. But the thing is, the thing that I come to understand about cash and tracking cash is that most companies don't have near enough cash. So that when good luck events come along, they can't take advantage of the good luck events that have come along because they don't have cash. They have to go out and borrow it. And all they've done is make their cost of borrowing more expensive, right? The cost of acquisition of that thing more expensive. When a bad luck event comes along, now they're in real problems because they don't have enough cash to weather the storm. It was a really great book that was written by Jim Collins and Morton Hansen called Great by Choice. And what they did is they tracked 30 publicly traded companies over the course, they tracked 16 companies over the course of 30 years. And the companies that did the best, the companies that weathered the storms better than any of the others, the companies that had the largest amount of growth over that 30-year period of time were the ones that had anywhere from 3 times to 10 times more cash on their balance sheet than their industry counterparts. Think about that. And that allowed them to take advantage of good luck events when they came along, and it allowed them to weather the storms when those came along. So I'm just letting you know, start stacking cash. And for me, I always want to make sure that my cash balance is higher from one period to the next. So there's that. So the other thing is I want you to start thinking about we talked about cash balance history, and I'm talking about knowing it from like on a chart, on a graph. So you know from 1 month to the next, did it go up? It better gone up by at least $1. And that's exactly the metric that I look at. So let's look at cash as a percentage of sales. Cash as a percentage of sales is a little tricky, but we can do it, right? We can do hard things. So what we're going to do is we're going to look at the balance sheet, and we're going to look at the income statement. So from the balance sheet, what we're going to do is we're going to look at the cash balance right up on top. The cash balance right up on top. So assuming that we're on a 30-day pay cycle, right? Let's say that our money comes in every 30 days. That's most businesses, not always, but if you're farming, it might come every 6 months or something along those lines. Well, let's just say that you're in a business where you're on a monthly income statement cycle. So you're going to look at your cash balance at the end of the month, right? So let's say this is for last month, this is for your 1031, right? October 31st. And then you're going to look at your income statement for the month of October, right? So you're going to look at your total sales, the total sales that you made, the total revenue that you made. So what I do is I like to divide the amount of cash as a percentage of sales. So what I do is I just simply do the metric and say, okay, I'm going to take my 10,000 in cash divided by the 114,000 in sales for the month, and it comes up as 8.7. Is that good? Is it bad? It's not good or bad. It's just, what is it? So if I'm looking at my cash as a percentage of sales, I can see that my cash is 8% of sales. Now, is that good, bad? I personally would like to have a heck of a lot more cash than that. I think only having $10,000 in cash for $114,000 in sales is pretty low. But look at the trend. The trend is telling me something. It's going, in the month of January, it's 8.7, February, it's 9.2, March, it's 11.3. Now, just because it's going up doesn't necessarily mean that's good, because what could be happening? Yeah, cash could be going up, which is a good thing, but sales could be also declining, which would not be necessarily a good thing. So this is why I want to make sure that you're taking it. It's just a metric. You're just paying attention. You're looking at all of the factors that factor into these numbers. But again, I'm tracking this. I put it on a spreadsheet. I want to know specifically that these numbers are going up and that they're going in the right direction for the right reasons. So this is all about growth planning, and you cannot be strategic if you don't know your numbers. And this is also important for you to grow, to avoid growing broke. So again, when it comes down to some basic success strategies, it's really important that you know your numbers and that you track your numbers. And I'm not talking about just logging in and checking your checking account every day. I want to know specifically at the end of each month, are you tracking your numbers, right? Because what you pay attention to is what expands. And a lot of times people are only looking at the net income number on the P&L or the income statement, and they're not looking at their balance sheet. So this is why it's really important to know your numbers, and it's also really, really important to track your numbers. All right, so this is pretty much the end of the presentation. I want to give you a couple free things, and I will let you know about the paid thing that's coming up. But hopefully you found this helpful. But if you are a Facebook sort of person and you are interested in joining our group, there's no cost to join, and we're not going to blow you up every single day with stuff. I know Michelle posts a lot in there, but you're welcome to be there. But if you're a jerk, don't come. I don't want jerks. Okay, so I just want to make sure that you understand. But she will put up the link for the Time Wealthy Advantage room, if that's something that you are interested in joining. And one other thing in terms of EventBrite, there it is. Thank you, Michelle. So for the EventBrite events, if you are interested in following for more events that are like this, again, totally free, I would suggest going to EventBrite and actually following us on that page. But if you want, the other thing I just want to make sure that you know is I do have this the live Q&A coming up this Saturday at 8 Eastern. So if you are interested in that, you can find that on the EventBrite page, just kind of the same place where you found us, here. And then it's just probably the easiest for you to do that. But if you are interested in that Q&A, that's probably the best, just because I have a lot of people that ask lots of very different questions around lead generation, around sales, around marketing, around employee engagement, around leadership, around management. I have devoted my entire life to understanding small business. I operate several small businesses. I get it. I know all the intricate problems that people have had. I've coached over 1,000 people at this point, and I know the problems that they're all having. And I'm just letting you know that it's not easy, but it's simple. So if that makes sense. All right. So that is the EventBrite. That is that's the strategist link. So if you're interested there. All right. So here is also a free resource. This is the free money and finance course. If you are interested in free stuff, this is totally free. And it kind of picks up where we left off in this session. You can go in there. There's lots of different money templates that you can see. I'm going to put myself down at the bottom here, and you can kind of get a rough sense of what the money templates are. And there is a chart of accounts example, which is helpful for when you're meeting with your bookkeeper or your accountant. So what are the line items on your balance sheet? What are the line items on your income statement? Just so you have an idea in terms of what all this stuff is: your assets, your liabilities, your equity, in your income statement, your revenues and expenses, all of that stuff is organized in your chart of accounts. When you're looking at your balance sheet, there's a very, very basic balance sheet example in there. So if you actually need to try to get a better understanding of your balance sheet, there's that in there. And this is all a money template that you have access to in the free money and finance course. There is an income statement example in there as well. There's also a template for you to track the balances in your cash accounts, your retirement accounts, your credit card accounts, your loan accounts, just so you can see the trend in your funds and what's going on in your balance sheet, what's going on in your income statement. And this way you can track your progress and see what kind of strides you're making towards your financial goals, right? So you can see if you're gaining on it. That's really important. For those of you who are interested in borrowing as a business, I have an underwriting example in there and also a personal financial statement. So for you personally, if you're interested in trying to put together a personal financial statement so you know how you stack up net worth wise, you can use that as an example as well. There's also an example in there for real estate, or what's known as DSCR loans. I actually was a commercial credit analyst for a while for commercial underwriters. I was a commercial underwriter for a while, and there is stuff in there for that. There's the balance tracking template, all of the different stuff that you can see in there. This is all the different videos. So you'll see the videos in there for chart of accounts. General ledger kind of walks you through all that. There's lesson 1. Here's lesson 2, which is the balance sheet basics, kind of what we talked about today. And then there's income statement basics, different things, a little bit more expanded on what we talked about. Then we're going to be talking about borrowing as a business, about different collateral types, something known in the United States as a UCC1, and just basic term loans for business. So that is all for the free money and finance course. Michelle went ahead and put that link up there. So if you are interested, just got to plug it in your email. And when you are logging in for that, you just need to go to strategicboardroom.com, and you can find the login for that under the courses and under the course logins. It's pretty simple. Just go to strategicboardroom.com and you'll see it up on the right-hand side when you want to log in on it. So for those of you who are interested in jumping off right now, there's nothing else, because I was going to talk a little bit about the paid course. So if you want to go, you're not going to hurt my heart, I promise. I had all my feelings removed in the Marine Corps. I grew up with one feeling, and that was a Scottish Italian household. So you probably understand what I'm talking about. But in any case, so I'm going to talk a little bit about the advanced money and finance course. This is, it's not a lot of money. I'm just letting you know right now, it takes everything that you learned from the free course into the advanced course. So you don't have to have 2 separate logins. What I did is I just moved all the free stuff into the advanced money course. So if you are interested in the advanced money course, all of those money templates that I mentioned earlier are also in there. The chart of accounts example, the balance sheet example, the income statement example, the balance tracking, the underwriting templates, the personal financial statements, all of that stuff is all in there. There's a lot of other stuff in there related to borrowing as a business, because I get a lot of people who are interested in that. There's also an advanced income statement and balance sheet example. So that way, if you're looking for a little bit more advanced stuff, this is going to walk you through some more advanced balance sheets that you'll run into, income statement examples that you'll look into. There's also something known as a CapEx calculator. This is called capital expenditure. And really that's for large ticket purchases, and how you can track that and know what your capital expenditures are going to be from any particular point in time. So this is really popular in the real estate space. So it's really important to understand your CapEx. And there's also something known as accounts receivable aging. And the accounts receivable aging, for those of you who might remember, let me take myself back up here for just a quick second. Accounts receivable aging, remember we talked about growing broke earlier on? Well, the accounts receivable aging is really important if you have a business where you have accounts receivable. So you have people that owe you money and you're not collecting on those. It really shows you how different accounts are aging. And let's say you have 3 or 4 different people that owe you money, the fact that you might have people that owe you money within 30 to 60 days, that's fine. You start getting over 90 or 120 days, your likelihood of collecting on that money drops precipitously. And that's just statistics. That's not just me saying it. That's actual statistics based on what's going on in the marketplace. So I want you to understand, understanding accounts receivable aging is really, really important. And there's also something in there related to accounts payable aging, which is you making sure you're paying your bills on time. So that's also important. So accounts receivable aging, accounts payable aging, all these different things are different money templates. And also there's all these different lessons, like I talked about, basic accounting, general ledger, chart of accounts, how credit scores actually work. Okay, so your credit scores, your FICO scores, for those of you who are in the United States, this is a big deal. Now, outside of the United States, this might not be as relevant, but it is important for you to know because the Fair Isaacs Corporation, it is really, there's lots of people that are not being told the right things. I'm just letting you know that it's not actually how it works. So there are metrics, however, that every business needs to know, whether you're in the United States or outside the United States. This is really important for you to know metrics that this is more advanced stuff that we talked about today. And these are metrics that are not complex. Again, simple 4-function calculator, or heck, you can even do it on an Excel spreadsheet. But these are metrics that every business needs to know. There is, oops, lost that. There we go. And then there's also, again, the advanced metrics we talked about, things like EBITDA. So for those of you who have ever heard of EBITDA, EBITDA is earnings before interest, taxes, depreciation, and amortization. And that is really a measure of the profitability of a business. That's really important to understand, especially if you're looking to get financing, and especially if you're looking to ever sell a business. Understanding EBITDA is really, really important, because most times people will come in, these private equity funds will come in and they will make an offer to you based on EBITDA, right? The valuation based on EBITDA. So that is that thing there. So we talked about more about advanced metrics, return on investment, balance sheet metrics, things like that. Something known as our flash report. There's other things that are powerful loan calculations and debt reduction tools for your financial toolbox. So like something that I know as a debt snowball. Debt snowball is really, really powerful, but there's also something that I teach known as a loan constant. And understanding loan constant is really, really important, because that helps you pay down debt that is the highest risk to your balance sheet, right? Because if you don't manage your risk, what you're being taught right now, and if you're hearing like things like Dave Ramsey and Susie Orman and people like that, they're telling you to pay down the highest interest, which I respect why they say that, because it's expensive, right? But the problem is not so much the interest, it's the loan constant, because the loan constant is what determines the amount of cash that you're paying out per $1,000. And that's really important. When you understand loan constant, now you understand which debts that you should be paying off, because those are the ones that are the most expensive, the most reductive to your cash flow. And that is something that I show you how to calculate. But again, very simple calculation, but again, you have to know what that is. So all of that stuff here, again, all of those different things that you're going to get for understanding all that, and it's just one price of $37. So, the understanding all of these different things, from infinite banking concept, different things like that. Michelle just went ahead and put that up there. If you are interested, again, the way to log into this once you have purchased it is, again, go to strategicboardroom.com. You'll see the courses and logins, and just find out where the paid course is, and you'll just click the button and log in. Okay, it's pretty simple. If you have problems, email us. We're going to email you, again, events@markdolfini.com. So we'll send that stuff out to you. But that's all I really have. So hopefully you guys found this helpful. If I will see you on other trainings. And if you are interested, again, make sure that you get registered for the courses on Saturday for the free Q&A session. And if nothing, please take advantage of the free money and finance course, because there's a lot of stuff in there that will help you, again, at least get a little bit more familiar with what you're learned today. So keep an eye on your emails for the follow-up email for this, for the video, the video replay. And I hope you guys have a great rest of your day. We'll see you guys next time.